All right, I think we've got, I think this is the link, guys. All right,
Yeah,
turn
looks
up
very bright.
volume. Omar, can you hear me? David, can you hear me?
Yes.
Okay, yeah. For some reason, people are getting let into the other link, but we're going to start pretty much, I guess, now. Omar, you going to share your screen with the presentation?
I am.
Excellent.
All right. So let me know if you guys can see my screen. Greatly appreciate it. All right. All right. So this is our third fund update call, guys. Just wanted to give you an idea. So Wednesday, March 13th, myself, Omar Khan, joined by Matthew Todman, also the co-founder of the company, and David Jarvis, he's our CEO and portfolio manager at Corton Capital. So the fund update call today is going to be a lot about a theme, the themes that are going to be playing out in the next number of years. And we do apologize about this little bit of a late start, but yeah, these themes will be playing out whether we like them or not. So the idea for us is to definitely, we want to have this fund update call be for you guys to let you know what's going on all the time, why it's going on, what it means, all that good stuff. So let's get into it. I'm going to go back here. So current themes we're going to talk about today, we're going to talk about cloud computing as one theme and how three of our major companies in the Alpha portfolio are going to benefit tremendously from this over the next number of years. So cloud computing is expected to increase substantially over the last few years. We're also going to go over the activity, how much money is coming into the fund, what the outlooks are, because that's another important thing. When the markets are a little bit, stagnant, like they are now, you want a lot of money coming in so that you're able to average down and eventually join the upside. And what to look out for the next few weeks. Okay, so this is what we wanted to talk about today. Today is cloud computing. It's a big one. Sorry, my apologies. There we go. Cloud computing. Now, this is a study from Acumen Research and Consulting. Currently, the spend on cloud computing, and what exactly is cloud computing? Maybe David, if you want to chime in here as well, if you have any thoughts. But what exactly is cloud computing? It's basically data that's stored virtually that people need. You don't have storage of that data, and it gets stored virtually, and there'll be an AI component to this as well. So currently, that expenditure is $495.3 billion, approximately per year. Okay. Now, that is a big number. Okay, 500 billion. So you look at the companies like Microsoft, Amazon, Google, they've had a good run up in price. They've gone up substantially. And what ultimately drives a stock price in the long run is the amount of money a company makes or doesn't make. In the short run, it could be interest rates, it could be geopolitical events. In the short term, a year or two, a lot of those short term factors come into play. So we're not concerned so much of what can happen in the short term because nobody really knows what can happen in the short term. What we're trying to look at here is these companies have had a big run up. Microsoft's the most valuable public traded company in the world. It has a valuation of 3 trillion. So the question is, can this grow a lot more? Like, a lot of the times people think, well, it's already gone up so much. Can it go up more? And that's the problem we want to look at today. What's the thing we want to tackle? So global cloud computing market is projected to grow at a CAGR, which is compound annual growth rate of approximately 18% a year. So that's a nice substantial increase, okay? It's going to have a major impact on IT and data handling, increase towards trends towards automation and customization, and it'll reduce costs, software and whatnot. So in 2022, North America dominated the cloud market. However, Asia Pacific region is expected a record compound annual growth rate of 19% from 2023 to 2032. So we know that the category is growing substantially, but we also know that the majority of the business right now is in North America, right? And mainly dominated by 3 companies. We happen to own these 3 companies. But there is a larger and larger presence coming in from Asia, okay? So let's take a look. This is Statista. Great source if you want to find out exactly what's happening in a visual form. And if you're like me, you like to look at things visually. Let's take a look at who controls that cloud computing market. Well, number one is AWS, Amazon Web Services. Okay. That is one of the major holdings in the Alpha portfolio. Number two in market share, excuse me, Microsoft Azure, controlling 24% of the market. Now, this is current as of the Q4 2023, okay? Now, Google Cloud controls 11%. Now, we talked about the Asia Pacific region increasing. You can see here, Alibaba controls 4% of the market, and Tencent Cloud controls 2% of the market. So, although the Asia Pacific region is growing in terms of cloud storage and cloud computing, it's still a very small segment. So if they grow at 19% and this area in North America grows at 18%, there's going to be multiple winners out of this. As you can see, Salesforce, IBM, Oracle also have some market control as well. And I would expect other players to come into this. Now, what does that mean exactly? Okay, let's take a look at, again, these three holdings, Amazon, Microsoft, and Google, are in our Alpha portfolio. And they're not small positions. They are large positions. Why? Because when you invest in companies, if you want to look at beating the market long-term, you have to take an outsized approach oftentimes. Now, let's take a look at Microsoft. Okay? Microsoft is a perfect example here. Cloud computing drives Microsoft's growth. Now, when we think about Microsoft, what do we think about? We think of Xbox. We think about Microsoft Office, we think about Surface tablets, we think about stuff like that. We don't really think about their cloud business. Now, this is 2 quarters combined, okay? So if we go to the first and second quarter of 2021 at the left-hand side, we can see that Microsoft was bringing roughly $31.9 billion in those 2 quarters in their cloud services business, okay? The one we just talked about, the one that's growing rapidly, okay? 48.3 million from every other part of their business. That includes Surface tablets, Xbox, gaming, LinkedIn, Microsoft Office. It includes all that stuff. Now, if you flash forward 3 years, you can see the other part of their business, right? The one in the dark blue there. It went from 48.3 billion to 53 billion, and that has the pandemic in there as well. So it's not experiencing a huge amount of growth. It's some growth, but not major growth, okay? The cloud computing division, this is the one we really want to focus on. Now, we went back to this, right? Let's just take a look at this one more time. 495 billion today in 2023 to expected 2.5 trillion, 2.49 billion, which is 2.5 trillion. That's a 5-fold increase in the amount of expected expenditure in the cloud computing division. Now, we know that Microsoft owns 24% of that market. Okay, so right now, in the first 2 quarters of the year, they did $65.5 billion, okay? Now, if that number is expected, and let's just say, theoretically, Microsoft maintains a 24% market share, and I would expect maybe this market share would go down, but let's put it at 20% as a hypothetical. And again, it doesn't mean it's going to happen for sure, but as a hypothetical, 20% of $2.5 trillion is $500 billion potentially that could be revenue coming into Microsoft just from their cloud division. Okay, so that is a massive, massive growth area for Microsoft over the next number of years. So do we feel comfortable writing puts and owning a position like Microsoft? Absolutely. This is exactly what we do at Theta. We analyze companies, we evaluate whether they will be worth more in the long term, and that will be determined eventually based upon how much money they make. Now, we can ascertain from this data that Microsoft is going to be making a lot more money on the cloud computing side. This 65 billion could increase many, many, many fold, okay? Now, the other parts of their business, I don't expect them to grow as rapidly, but this is an area of major excitement. Now, Microsoft stock has done exceptionally well over the last number of years. So people are like, well, how much higher can it go? Well, if the market is maintained in the cloud computing division and that market grows to 2.5 trillion, the answer is the potential is the stock can go up substantially from here. Why? Because they would be making that much more money. Also, who else is in there? Amazon. Amazon controls 31% of that market. This is a high margin business. It's called software as a service, SaaS. Google controls 11%. These companies, if that number goes from 500 billion to 2.5 trillion, are going to make a lot of money over the next number of years, which should drive their stock prices substantially higher. So we are very happy to be investing in these themes. Now, let's take a look at another company, Amazon Web Services. This is from 2013 to 2023. Now, they're the market leader. They control 31% of that market. In 2013, $3 billion is what they were deriving from Amazon Web Services. Look at the growth there to 2023. $90 billion now in annual revenue for Amazon Web Services, the number one leader in that segment. Now, if they were able to maintain that, and you get a five-fold increase, this would be an annualized revenue by 2032 of $450 billion annually. What does that do to the stock price? Well, we'll have to look at margins. So margins, by the way, just to this, margins right now in this, according to Microsoft, their gross margin in this particular business is 72%. That means for every dollar they make, 72 cents, not dollar, is gross profit. Now you have to pay your employees and research and development and all that other good stuff, but 72 cents of that dollar is profit. That is huge. So we expect this area to grow very, very nicely. And what we wanted to do when we do these calls is when the market goes down, inevitably it will. Amazon will go down sometimes, Microsoft will go down sometimes, Google will go down. But what we're trying to look at is not what is happening in the short term. What is happening in the long run? And from this data, we can gather that there's going to be substantial growth in the biggest growth category for all three of these companies, which is the cloud computing division. It is also a very fat margin business, which is excellent for bottom line profits. Now, I'll turn it over to Matthew and David and see if you guys have anything to add here.
Yeah, I mean, here's the thing, right? To me, what this data is saying is that there's a stalwart or like kind of bellwether stock like Microsoft, which, you know, it is a mature tech company that is in a that's gotten itself into a an area that is really expanding. Now, that being said, you know, we do like Microsoft, absolutely. We, you know, in the past and currently, we do trade options around Microsoft, absolutely. But when we see this type of data to say, listen, like, you know, the total market could be 2.5 trillion, and now it's sitting at, you know, 500 billion. And you see that, hey, listen, if you maintain your market share, it's going to be like a multiple fold increase in potential market share. Well, this creates a nice warm and cozy feeling, right? Notwithstanding any other inputs into stock price outcomes, right? Now, that being said, right, I also like the fact that this is not a new volatile company in Microsoft, right? Like oftentimes the newer the company, probably a little bit more variability in price action, right? What were you saying, Omar?
I was saying Amazon as well. These are not new
Amazon
companies.
as well, absolutely. Amazon is it's not a spring chicken, right? In the tech world, Nasdaq world, these are all like you know, they've been around for decades and decades and decades. And that to me gives me a lot more of a warm and cozy feeling when we are trading around these positions than a newer company that potentially does have a heck of a lot more volatility, but then also enhanced price variability, right? So, you know, it is a good opportunity for us, not to say that we don't have those stocks in the portfolio. Absolutely, we do. But, you know, we are potentially more careful on stocks with higher volatility than stocks with slightly lower volatility, such as this one. So it is an exciting type of, you know, it's like you see a bellwether stock with an exciting path down into the future, right? So, you know, that's what this kind of data tells me. Of course, we got to validate the data, right? Data looking out a number of years. Hey, you know what? Everyone has an opinion and no one has a crystal ball, right? So that's definitely something we need to be cognizant of, and we are. We do look at a number of studies that say, okay, what are the size of these markets going forward, and is there room for all these players? Yeah, absolutely. We brought a couple of these studies to surface here, but again, this is an evolving kind of discussion, and once discussions are had, then positions are taken, right? So we are constantly on the lookout to say, okay, what are the next kind of studies out there? And indeed, like consulting firms, accounting firms, data repositories like we're seeing here, absolutely, they all put out kind of aggregate and estimated data, and it's our job to kind of go in there and determine what's the data that we are going to be using to position our portfolio. David, anything else there?
Another way of kind of looking at this information is to take a look at what multiple some of these growth stocks, such as Amazon and Microsoft, trade at, and compared to a bank stock, they trade at a significantly higher multiple, which simply means that there is an expectation of future earnings growth. What these studies show, or what this analysis shows, is that that higher multiple is potentially justified because we can see a pattern, we can see a place where the growth can occur. When you take a look at a bank such as Royal Bank of Canada, they have a pretty good idea of where their growth is going to be, plus or minus a few points over the next 5 to 10 years. And as a result, they trade at a lower multiple. This is justification for why these stocks trade at a premium. There is significant opportunity for them to convert potential into real dollars. And this is very different from the tech boom of 1998 through 1999 that culminated in the great tech bubble burst in the first quarter of 2000. Because there was no revenue, there were no earnings. These are not, it's nowhere near the same anymore. What we have are companies that are banking serious dollars to the bottom line. And what this study shows, or what these reports show, is that it is not unfounded or unreasonable. Thank you.
Thank you, David. So what David means about multiples, what a company's trading at. So for example, Microsoft is trading at 37 times earnings. That's a PE multiple, a PE ratio. That means for every dollar of earnings they make, the market is giving them a valuation of 37 times that $1. So if you make 100,000, 37 times that. Okay, so that's you're paying a lot for the earnings. But the idea is that if those earnings increase substantially, well, then you're not paying as much. Now, let's contrast that to, let's say, a typical bank. And let's say a typical bank might trade at 10 times earnings. That means for every dollar that bank makes, the market is giving it a valuation of 10 times that amount. And the reason is simple. As a company matures, it does not grow as fast, right? So therefore, that premium, as David was describing, is not justified. The Royal Bank of Canada, yeah, it grows. Why? Because people come into the country, they need banking services, they need insurance, they need asset management, and it grows. And maybe they get some international business, but that growth is measured every year, as David was saying. It's not going to be 30%. Now, Amazon, let's take for example, or Microsoft, although we think of them as very, very mature companies, what we don't realize is there are certain segments of their business, this one being the most profitable and the biggest, is growing extremely fast. So the market says, hey, we know that you're growing really fast and this is a high margin portion of your business. We're going to give you a higher multiple. In Microsoft's case, 37 times earnings. But if your earnings were to go up substantially and the price stays stagnant, that means that earnings multiple comes down. So you have to be cautious. Am I paying too much for this company? But at the same time, you know that this company is going to be making a lot more money if these things come to fruition. So we just want to quickly explain it. The future is very, very bright when it comes to what is happening with this. But we'd be happy to elaborate if anyone has any questions. All right. So what's been happening over the last 2 weeks? Well, we got 150 accounts in or in transition. Okay, so we want to thank you so much for your continued support. We bring money in all the time. there's a lot more people still to contact, and thank you very much for everyone's support. We cannot tell you how much it means to us. I've met with almost 50 investment advisors now, and the idea is when you meet with an advisor, you want to look at getting institutional money and other money. Now, a financial advisor would work for a company, let's say, company X like RBC, and they would have their own clients, and they decide what investments those clients go into based upon suitability and other things. Now, when you're able to get on that platform, a lot more money can come in. So we're very close to getting on a few of these platforms and getting advisors on. And why that matters is, so we have, not only do we have a lot of retail accounts coming in from Theta students and others and friends and family, we also have other assets that are going to be coming in from the advisor channel. And why is that so important? Well, that's really important because you always want a lot of new money coming in. It lowers the fees on the funds because you have certain fees that you have to pay for. But the larger the base of clients and the base of assets, the lower those fees become as a percentage. So this is what we'll be focusing on in the next couple months, is bringing in a lot of retail clients and also getting approval on the advisor platforms and bringing a lot of money from there as well, and continue to grow this and waiting for our themes to play out. Now, let's take a look at the current exposure as of
March 11th. That's the March 11th. I think Omar froze a little bit there. Omar, can you hear us? But yeah, as of March 11th, right?
As of March 11th, there is none in there. So in this portfolio, we have Alphabet, Amazon. So Alphabet is Google. We just talked about them. They control 11% of the cloud market. They're growing substantially. We have 9.5% exposure. We want 10. We have Amazon, the leader in that segment. We want 10% exposure. Apple, there's a little bit less. We want to keep that around 8%. Why? Because Apple doesn't have any real growth area that we're looking at that's explosive growth. Now, that new Apple Vision Pro that came out, we'll see how that sells. But for the most part, it's a more mature company with no real growth driver at this point in time. Refresh cycles are taking a little bit longer. So really interesting to see what Apple does, but they are so embedded in culture and across the world that they will continue to churn out more profits, we believe. Microsoft, that is going to be the one of the biggest holdings, and Microsoft, the biggest company in the world. And again, can it go a lot higher? Well, yes, it can, because those profits from that cloud computing division could be very substantial. Tesla, we have 12% right now, and we want to try to accumulate as many shares as we can while this is low. And the reason is simple. Excuse me. Tesla will be introducing the Model 2 next year, slated for production sometime second half of next year. That is a subcompact car that is supposed to be $25,000 US. If you have a $25,000 electric car, it could sell a lot of units. And what you're also looking for is continued growth in their energy storage division, which is doing really well. It's got high margins and it's growing rapidly. Now, Elon Musk has said in the past that that part of the business will be as big, if not bigger, than the automotive division. So it's really nice to see that part of the business ramping up. So we want around 12% exposure. We've currently got 12.8 or so. AMD, that has done extremely well because of the AI boom and the insatiable chip demand. We're going to talk about that in a future fund update call. The segment of chip demand globally, who the players are, and what is the projected growth over the next number of years. Meta, same thing. Meta is Facebook, Instagram, etc., WhatsApp. Eli Lilly, we've got around, and that is a non-tech related company, right? It is a company, it's a biotech company. Taiwan Semiconductor, they make all the chips for companies like NVIDIA, AMD, etc. We have NVIDIA in there. That has been hot in the news of late. And the last company with the lowest amount of exposure currently right now is Airbnb. That is around 5%. And that is taking advantage of that theme of working remotely. Okay, so that's the current exposure. Expect a couple names probably to be added from here, but this is kind of roughly what it is right now. We have begun trading it right now. So the Alpha Fund, if you're interested, these are the fund codes. It is a high risk portfolio, again, because of the volatile nature of these positions in the short run. Okay. Now, what have we actually generated on the fund and how much money do we have outstanding? Right. So we know a lot of money is coming in. All right. Our job is to put that money to work. So we've sold 72 cash secured puts so far. That has generated us roughly 2.3% premiums on the portfolio. We only own about 10% of the position in actual stock right now because it hasn't been assigned to us yet. But we've exposed the majority of the portfolio. And the reason we don't mind doing that is because we know a lot more money should be coming in over the next number of days. We're also keeping the average days to expiration kind of short. It was at 18 in the last call. Now it's at 22. And the reason is because the market does really well until about May 5th. So we want to be careful not to agree to buy too many positions after May 5th. Why? Because the market doesn't do that great in the summer months. It's more flattish, and we'd like to build up a cash position going into the summer months. So hopefully we can acquire some of these positions kind of cheap. So 2.3% so far as a premium collected. And it's a bit misleading because, the money is starting to come in now. And, now you have to deploy all that capital. And we haven't had the capital in the accounts because the transfer process does take some time. Anything to add here, David or Matthew?
No, I think we're positioning this portfolio appropriately, given the investment mandate. People, there was demand for a product that is assertive and has a little bit of volatility in it. And I like to describe it, and so does Omar, as like it's a great destination, but potentially a rocky road. And I think that's it. I mean, that being as we have started, certainly hasn't been a rocky road. I think to me, these stats are great. So I'm quite happy to see that. And again, this is all in line with what we believe is good and sound options writing practices, right? Especially when you're taking possession of the stock, you want to make sure you always want to own what you are writing an option on. Like, that's a fundamental principle that we will always abide by. This is not for speculation, right? And that's a tenet that's often overlooked when you say, oh, okay, yeah, first step of writing a put, find a stock you want to own. Okay, next you do this. Okay, hold on. Finding the stock that you want to own, that mandates you finding an investment thesis on something you want to stand behind, because at a certain point you are going to go long. So that previous couple slides, a couple slides ago, when Omar showed our holdings and exposure, these are stocks that we believe are going to be doing better in the future than they are today, and that's why we want to be long that exposure. But I'm quite happy to see where things are going, and I'm quite excited to see what this looks like in the months ahead.
David, anything to add here?
No, what we've been doing is following the plan as outlined from the very beginning, identifying stocks, significant growth focused stocks that are not speculative startups, but well-established companies, and overlaying it with an option strategy to selling puts to establish a lower buy-in than just simply buying it directly in the market, and then selling calls to enhance the returns.
That's exactly what we're doing. And we're
That's
taking
correct.
seasonality. So that's where the portfolios, guys. Money keeps coming in. We keep selling puts, trying to enter positions. Great thing is we're collecting a lot of premium along the way. So what to look out for in April? Well, April tends to be a volatile month. It's the last good month of the favorable period of time, which ends on May 5th, approximately. Now, we have a couple catalysts coming up. We talked about this last call. We got rate cuts coming up more than likely in the second and third quarter. We don't know how much they're going to be, how quick they're going to be, but the market's pricing in these rate cuts. And rate cuts are great for the market. Why? Because companies can borrow cheap. That means they can grow their businesses with cheap money, which is great. Secondly, consumers, when they're financing products and or services, it's cheaper for them to buy those products and services because financing costs are lower, and people have more disposable cash because of now all of a sudden your mortgage is costing you less. Well, you're going to have more money to spend on stuff. U.S. elections coming up as well. We talked about this again last call. This is something that is going to be a bigger and bigger issue as we get closer and closer to the election. It looks like it's going to be Trump and Biden rematch. We'll see how it goes. So why does this matter? Well, it matters because generally speaking, the stock market prefers Republican president. So if it becomes clearer and clearer that the Republicans are going to win the presidential election, then the market's going to say, great, that is a good sign. That means the stock market, and we're going to have maybe some tax cuts, business-friendly environment. That is a tailwind or a boon for the stock market. Now, if the exact opposite occurs and the Democrats win, it might not be the stock market might not view it so favorably. But again, this is still something that's evolving. Who knows how the election's going to go? Polls only tell you so much, but right now the Republican Party is leading according to most polls. So just want to conclude, guys, if you're interested in investing in the fund or you have any friends and family, here is our contact information. We'd be love to have a chat with them. Matthew, myself, and the rest of the team are working around the clock. We want to make this an overwhelming success over the number of years. And again, we can't thank you guys enough for your continued support all along the way. And we want to keep you constantly informed. So if you have any questions whatsoever, please do contact us. The disclaimer, which is always obligatory, please read this at your leisure. David, maybe you can provide us a brief synopsis of this disclaimer.
The disclaimer basically points out that Corton Capital, the firm that I created and I'm the president, is registered with the Ontario Securities Commission as an investment fund manager, portfolio manager, and exempt market dealer. That's a very fancy way of saying that Corton is responsible for the fund. And in that context, if anyone has any questions or issues, you are always welcome to reach out to anyone at Corton, which includes obviously Omar and Matthew, but also to myself as well.
Thank you, David. And then that's it. Thank you guys again so much for your help and all of your help in building this company. We're going to continue to work hard. You know what? We really believe in this. If you have the right people and you work hard and you have the right idea, the natural outcome is success. And that is exactly what we're trying to do here. And we are completely committed to that over myself, Matthew, David, over the next number of years. Matthew, I cannot see the questions. Perhaps you can.
Yeah, so there's a couple questions here, guys. At this point we'll stop. Well, we'll continue to record, but at this point we'll, for other purposes, we'll stop the actual presentation portion. What is your opinion of the fundamental growth in the markets that generate the growth of the companies? Will most of it come from the developed world, or will it come from India, China, Africa over the projected 2023 to 2032? Well, that's certainly a loaded question. Where does growth come from over the next 7 odd years?
Yeah.
I mean, listen. Obviously, right now the developed nations, they do have the bulk of the demand, right? In terms of buying power, but India and China account for like almost half of the world's population. So how do you discount that?
Not quite half, but about
Well,
30.
almost half, right? Like at least like 3 billion of the 8. So yeah, almost half of the population, right? So of the planet. So I mean, I would think that it's going to start. North American markets and developed world nations will certainly continue to be strong presences. Absolutely. I think the Indian, China, and to a certain degree Africa will catch up eventually. But 7 years, it's a long time, but yet sometimes it's not such a long time. So I don't think it'll be. I think it may just be significant growth, but we'll see. David, how about you? This is all speculation, by the way. There's no data here.
It's an excellent question. Will the developing world continue to accelerate, and as they accelerate and increase the average wealth per capita, does that increase the demand for some of the more expensive services that we get in the OECD countries? And I think the answer is fundamentally yes. We certainly saw that in China when under Deng Xiaoping, when he kind of liberalized the country. It brought an awful lot of people out of poverty. It's one of the reasons why China is where it is. And so I do see in the developing world, and it's interesting, is India in the developing world? Is it moving into its own place? Yeah, there's lots of places where there's going to be continued growth, which will translate into demand for more services, and services are traditionally higher margin products or revenue streams.
Yeah. Okay. So thank you guys. Hopefully that answers or helps provide some context around your question, Harry. Wasim, what is the rationale behind 10% target exposure to Eli Lilly? Is it sector diversification, and why this particular company? So a little bit. So yes. So it is sector diversification. Absolutely. We do not want to be tied solely to the cloud and AI or generative AI train, although we do believe in it, and obviously it's popular, but like we cannot be tied to it entirely. Like even when you look at the Magnificent Seven, there are the Magnificent Seven, but like they're all pretty interconnected, right? Either they're buying chips from the same people, or they're after the same target audience, or they're in the same marketplace. They're pretty interconnected, right? We wanted to also expand our scope here to have a little bit of sector diversification, and go into a biotech company that we believe is fundamentally sound and can be traded around. And that was Eli Lilly. And yeah, we do have kind of you know a bench team that's emerging right now, but right now it's Eli Lilly. David, any more context around that?
Yeah, diversification for sure, but Eli Lilly is a well-established drug manufacturer, but they're also involved with. They have a number of catalytic stocks and products out there. The most significant being they're exposed to developing drugs to manage weight loss. I've personally owned this stock for a number of years, along with um, uh, the other drug manufacturer, Adzo, for the very simple reason there are an awful lot of fat people in the world. And that's obesity is a growing issue in the OECD countries. And the demand for this product, I hate to say it, is just going to go, is stratospheric. In this country right now, you cannot get Ozempic properly. You cannot. Unless you're like type 2 diabetes with a special relationship with your pharmacist. In order to be on Ozempic, you need to be on continuously. You can get it sporadically, but I can speak for a number of people that I know, including people in my family. It's almost impossible to get. They just don't have enough and they can't keep it. Eventually, they'll ramp up production. But I hate to say it, all you have to do is go to Florida, Texas. I look downright athletic.
Of course, anywhere you go, you look athletic, David. And
No, no, I don't.
remember, ask your doctor if Ozempic is right for you.
Yeah.
So
Well, that's that. I hope that explains that diversification, and we think it's a major growth area. We've seen. Hopefully, that explains it. We are looking at maybe another biotech company or two, but that's the basic rationale behind the decision.
all right, guys. Thank you for joining us. We will see you in 2 weeks. We will be uploading this onto YouTube as well for you to share with your friends and family if you want to take another look at it. But thank you so much for your support, and we wish you a wonderful afternoon in Southern Ontario. Trying to get outside. It is absolutely beautiful today. Thank you, guys.
Thank you.